Good evening, everyone. How are you all? Yeah, this is Naveen Gorky Kamaraj. I'm very glad to see you all again in this seminar. So today we are going to have a webinar on the basics of candlesticks, and also we will see about what are moving averages, and also we'll see about moving averages, convergence and divergence. So let's get started. This video is for educational purpose only. Please watch it. And if you have any questions at the end of this session, please feel free to type your questions. I'll get back to you. Fine. Now, let's start with candlesticks. So every day when we are trading, we used to see similar kind of charts on the trading platform. I'm showing a trading platform from Alice Blue. So every day we are seeing charts like this. So let's get in more detail and understand what are these candlesticks and how we can understand them. Fine. So all trading platforms have multiple charts, like I told you, and there are also numerous studies for technical analysis. So to be a successful trader, knowledge of technical analysis is crucial. So the first step in technical analysis is to understand candlesticks. So what are candlesticks? The candlesticks were actually first used by the Japanese people in the 1850s for technical analysis to trade their rice. So today, even today in the modern trading world, candlesticks are used visually to represent and interpret the price action of stocks. Let's get more insight onto this. All right. Fine. So candlestick charts, these are created from a data set which contains open, high, low, and close prices. So this is done for a time period. So what is a time period? A time period can be anything from like 1 minute to 3 minutes, 5 minutes, 10 minutes, 15 minutes, 30 minutes, 1 hour, 1 day, 1 week, or even 1 month. So the candlestick chart is prepared from the data set of open, high, low, and close values for the given time period. So I'm just showing you a candlestick here. If you see here, this portion it's called as the body, and also we have this upper and bottom portions which we call as shadows. So they are also called as wicks or tails or whatever. So this is the basic structure of a candlestick, where we have the open, close, and in between high and low. Now, let us understand the candlesticks much more. Fine. If you see this, we have two candles here. One is in green and the other one is in red. If we take the case of the green candle, there is a body, and also we have upper shadow and lower shadow. So what happens is actually the price starts here. For this candle, the price starts here and it closes here. In between, it goes high up to this and maybe low up to this. In this case, if the candle is green, it means it's an uptrend candle. The price moves upward compared to the open and the close. So that's the meaning of an uptrend green candle. Now, coming to this second candle, here we have a red candle. If you see here, the price actually starts here. This is the open price. Maybe it goes up, then again it comes down, and then it closes here. So the candle which opens and closes, the price goes down, which is called, we call it as a downtrend candle. So this is the basic of the two types of candle. One is the uptrend candle, and the other one is the downtrend candle. Okay, let's get on to the next one. Now, we were seeing about open, high, open, then we have the close, and we have the high and low. And this is uptrend candle. So we don't know actually what happens is the candlesticks, they do not reflect the sequence of events between the open and close. We really don't know what happens between open and close. If the price, like from the open, it goes to low and then it goes to the high, and then finally closes at the close price. This is one scenario. Or maybe from the open price, it went to the high price. Then after that, it went down to the low price. And then from there, it went to the close price. So it can be both cases. So the high and low are fixed. The high and low are obvious and indisputable. But we don't know which one came first. Whether the high came first or the low came first, we don't know. In this case scenario, the same candle, maybe the low came first. In this scenario, the high came first and then came the low. So we cannot interpret this from the candlestick chart. Okay. If it is a green chart, the assumption is that the prices advance most of the session. But we really don't know which came first, the high or low. Okay. So this is about the candlesticks structures. Now, I think you have an idea of the head, the open, the close, the body, and the shadows. So actually, candlesticks can be of different shapes. And also we can have multiple candlesticks together. They can be combined to form various patterns. Each of these patterns have a different meaning. And each of these shapes and patterns can be used to recognize. They tell us a meaning, whether the trend is onward or the trend is reversing and all these things. So there are a lot of patterns, like we call it as the hammer, the hanging man, the piercing line, the engulfing bull, bullish harami, doji, there is star. There are so many patterns of candlesticks. So today in this session, our focus is mainly to understand the basics of candlesticks. Then we'll go for the moving average, and then finally we'll go for the MACD. So next week we'll have a detailed webinar on identifying and recognizing the different candlestick patterns. So I think you have an overview of how to read the candlesticks. Now let's go to the moving averages. Okay, before going there, let me show you again the candle chart so that you get an idea. So now here we have different candles. These are all different candles. Here we have, this is a candle where we have the open, and then this is the close price, and this is the high, and this is the low. In this case, this is the open price, and this is the close price, and this is the high and the low. And also, the most important thing about candle is we have a time frame. Like I said earlier, it can be like 1 minute or whatever, like for 1 minute. So in this case, we have so many options: 1 minute, 5 minutes, 10 minutes, 15 minutes, 30 minutes, 1 hour, 1 day, 1 week, 1 month. So we can select whatever we want based on our needs. Okay, you see this? Now I'm showing a 10 minutes candle. Fine. Now let's get back to the moving averages. All right. So moving averages or moving averages are simple technical analysis tools. It smooths the data of the price by creating a constantly updated average price. And also it filters the noise from the random the price fluctuations. So it's actually an average price. It's a continuous average price, and it filters out the noise. So the time frames, like as I said, or the average lengths are like 10, 20, 50, 100, and 200. This is like 10 is short, and the 200 it's a long time period. So we can apply to any one of our time periods. Now, the beauty of moving average strategies is these can be applied to any kind of traders, like investors who are going to hold the stock for a long time, or short-term traders like intraday swing scalpers, or these kind of people also, they can use the moving averages. So moving averages basically they help to identify the trend direction, and they also determine the support and resistance levels. Moving averages themselves are useful enough, but also they are the basis for many of the technical indicators like the moving average, convergence, divergence. So many technical indicators depend basically on moving averages. Now, the moving average can be calculated in different ways. There are many types. For example, we have the simple moving average, we have the exponential moving average, we have the weighted moving average, we have the Hull moving average. There are so many. let me explain what is simple moving average, SMA, and exponential moving average, EMA. So, for example, SMA of a 5-day. So a 5-day simple moving average, how it works is it adds up the 5 most recent daily closing prices. Then it divides by 5. For example, the prices are 5 rupees, 10 rupees, 7 rupees, 12 rupees, 10 rupees for 5 different time periods, the last 5 different time periods. Then it's divided by 5, the total number of time period. This is simple moving average. So what happens is each average is connected to the next, creating it's a single flow line. Here, for the 5 different time periods, the percentage or the weightage is all same. Like 5 days or 5 candles before, this has the same weightage as the latest candle. This is called as simple moving average. Now, there is one more, which we call as exponential moving average. So this calculation is a little complex. It actually applies more weightage to the recent prices. So exponential moving average has like a simple exponential moving average. Then we have a double exponential moving average. Then we have the triple exponential moving average. That is, we get more weightage on the latest prices. Now, if we're going to plot a 50-day simple moving average and a 50-day exponential moving average on the same chart, we will note that exponential moving average reacts more quickly. When the price changes and the candle, the SMA is slower to respond compared to the EMA. I'll show you now. Here, in Alice Blue, I'm now showing a 10 minutes chart for State Bank of India. Here I'm going to the studies. I'm selecting moving average. Yes. And here I'm going to select a time. Let us keep it as 550. No issues. So it's a simple moving average. Okay. I'll keep the color as yellow. Okay. If you see here, this is the simple moving average. 50. Okay. Now, I will add the exponential moving average. Right. Let it be in red. Now, if you see that, see the yellow is simple moving average and the red is exponential moving average. Now, if you see that when the price moves, the exponential moves faster. See, this is lagging. Simple is lagging and the exponential is faster. So this is what I wanted to tell you. Exponential are more faster when compared to simple. The reason is they have weighted. They are weighted to the latest prices. They have more weight. That's the reason exponential is faster. Okay, fine. Now I showed you this. Let's get on to the next one. All right. Now I'll just show you some simple. We just saw how to set up the moving average indicators on the charts. Now let us see how we can use these strategies. Like simple the moving average strategies can be used for intraday traders and also for long-term investors as well. I'll just give you 2 scenarios. For example, we are going to show a SMA 50 on a 10-minute chart. So let's see what happens. Okay, now we have this line. This is the moving average, simple moving average 50 line indicator. Now, how do we use this to trade? See, when there is when the market price crosses the moving average from up to down, here we get a buy signal. All right. And also here we get a buy signal. Here we get a buy signal. And we have sell signals here. I'm just showing it for a couple of days. If you're going to have it for one simple day, we will have, you see this? Oh, I showed you how to do it for, let me show it for only one day. Now here, this is on Friday. There is one signal for sell here. The price crosses the moving average 50. So here we'll get a sell signal. So here we get another sell signal. And here we get one buy signal. Okay, you see this, when the price crosses from up to down, and we get a sell signal. So for example, in this case, if you're going to sell here, the price is somewhere around 197, and it goes up to 195.45. This is a 10 minutes candle, and the price goes up to, like, you get almost 1.5 rupees. And here, if you're going to enter at this range, the price is 197.4, and it goes up to 198.15. So it's almost 65 paise. So you get signals like this. Same way, there is a sell signal here, and the price goes down. If you are going to enter here at 197.4, the price goes down up to 194.8. So that's a huge price difference, almost like 3 rupees. So this is one strategy where we'll have different signals for entry and exit. So I think this is clear. We have three signals for Friday, wherein we get 2 sell signals and 1 buy signals. So we know the entry, where to enter from these things. So this is one strategy. Let me go to the other one now. The other strategy. Okay. Now, if you are talking about long-term investors, usually there is a strategy which can be used, which is like, instead of using a 10 minutes candle, if you're going to have a one-day candle chart, and then if you're going to have 2 exponential moving averages, 50 and 200, you will get buy and sell signals. Let's check it out. All right. I'm going for exponential 50, which is going to be, sorry, which is going to be blue. And I'm going to add moving average 200, which is going to be red. Okay, both of them are exponential. This is exponential 50 and this is exponential 200. Now let me change it to one day. So now, for example, I'm showing this State Bank of India for this case also. If you notice here, see, this is moving average 50 and this is moving average 200. If you notice here, there are 2 lines, both are exponential moving averages, but one of them is responding faster to the price changes and the other one is slow. This is because of the period, which we keep as 50 and 200. Usually 200 is slow and 50 is more faster. Now, here the strategy is, when the slow line is crossed over by the fast line, it indicates a buy or sell signal. I'll just show you now where we get signals, okay? Now, here there is a crossover. If you're going to sell here, because the price is, it's crossing from up to down, so here we have a signal for sell, and here we have a signal for sell, and here we have a signal for buy. The strategy is very simple. So we are going for and this is a one-day chart. So if we had purchased here on this day, I'm just going to show you the price exactly. Okay. So if we had purchased on this date, example, the price is 267 here. on April 9th. If we had purchased and hold it, it had gone up to 244. You see this? We will get this benefits. This is our profit. Okay? This is for one sell signal. Now, we got a buy signal here. If you're going to buy here, you see this? This trade is a loss. This did not work out. This trade is a loss. If you're going to buy here, we'll get into trouble. Or actually what happens is, is my video clear? I'm getting a message that some of them are not able to see the video. No, it's okay, it's clear. So here there are three calls given. One is a sell here, where we got a profit, and one we got a buy signal here, which we did not get a profit, and we got a loss. Now, there is one more sell signal here. If you're going to take it, we got a huge profit over here. So this is the reason why we have a stop loss and targets. So in case our strategy fails, there is a stop loss to protect your loss. It cannot be open. So there is a limit for your stop loss, and okay, you can exit it. So this is one more strategy. So I have shown you how the entries are calculated here based on the moving average exponential 50 and 200 crossover. I don't know why my voice is so low. Fine, let me try again. Now, let's get back to the presentation. So I showed you about how two strategies. One is for using simple moving average on a 10 minutes candle chart. I showed you how we can, whenever there is a crossover, we get a buy signal, and whenever there is a crossover downwards, we get a sell signal. Now, I showed you one more thing, which is for the long-term investors, which is like exponential moving average 50 and 200. It can be done on a one-day candle chart or a 1 week or whatever. Here also, whenever these two lines cross over, we get trading signals. Okay, please check out these by yourself. Change the time periods, and also, like instead of 50, you try 25, you try 100. You can try different combinations. Okay, and also you check out the charts for 1 minute, 5 minutes, 10 minutes. You can try out different combinations, so you will see the results yourself. So once you see this, how it works, you will understand it better. So there is one point I wanted to say here. See, if you're going for 1 minute, the risk is very less, and the profit level is also very less, because the movement will be very small. It's not going to move in a drastic way. So if you're going for a 1 minute candle, your profit or loss is going to be very less. If you're going for a 10 minutes candle, you have more risk and you have more possibility of getting more profit or loss. Okay. Now, if you're going for 1 hour, people also trade with 1 hour. If you're going for 1 hour, there'll be a huge movement up or down. So there is huge risk and reward. So check out these different strategies by adjusting the time frame on the, as I showed you on Alice Blue. You will understand a lot of things. There are so many ways. Check out whatever is convenient for you and find it out. Okay, let's go on. Now, there are some important points. First of all, moving averages are calculated based on historical data. That is the candle 50, whatever we give, 50, 200, 10, whatever. These are not predictive in nature. It's just based on the previous, and we have a crossovers and we do it. So any moving average with a short time frame will react much quicker. Whenever there's a price change, if the moving average time frame is small, it moves along with it in a faster way. And if you're going to have a longer look back period, it's going to be slow. And one more thing I showed you, exponential moving average is moving faster than simple moving average. Okay, and moving average crossovers are a very good strategy for entries and exits. As I showed you how to do the entry, same way you can also exit. You should not hold beyond the next crossover. And as I told you, if you're going to go for 1 minute or 5 minutes or 10 minutes, see, if the time range is short, you'll get more signals. If the time range is more, the number of signals will be less. Moving average basically reduce the noise. So based on your risk and your money management, you can have the time frame accordingly: 1 minute, 5 minutes, 10 minutes, or 15 minutes, 30 minutes, whatever. And there is one more important point, like we have two markets. Like one is a range market, wherein the price moves in the small bandwidth. This is called as range market, and the other one is trend market. It just goes either up or down. So moving averages, or they work very well during strong trending conditions, and during the choppy or ranging conditions, they are not good enough. You will get a lot of false signals. It will go up and down in a short range, and it will be of trouble. Okay, so these are the key points about moving averages I wanted to tell you. Now, let's get on. Fine. As I told you, we are going to talk about MACD. What is MACD? MACD is basically a momentum oscillator. It is used to trade trends. I'll show you what is an MACD. It appears in chart as two lines, and it oscillates. It oscillates between 0, and there are no boundaries. It can go any way up or down, or whatever level it can go up and down. It's an oscillator without boundaries. Okay, how is it calculated? I'll show you now a real example. Let me show you. I'm showing you an MACD for 10 minutes chart. Here you see that there are three things. Number one, there are two lines. One is white line and one is red line. And also you have a histogram. And there is one line in the middle. Okay. So what are these? Sorry about that. I got some message and I had to check it out. Fine. Here in MACD, there are two lines basically. One is called as the MACD line, which is the white one, and there is a signal line, which is the red one. Also, we have a zero line, and we have a histogram with green and red and up and down. What are these? Fine. How these are calculated? See, the MACD line is calculated by subtracting the 26 period exponential moving average from the 12 period exponential moving average. So the line, the white line, is calculated by subtracting 26 period EMA from the 12 period EMA. The signal line is created from a 9 period EMA of the MACD line. And the histogram it's calculated and plotted based on the difference between the MACD line and the signal line. Okay, I'll show you this now. You see this? This is the 12 and 26 difference, and this is the signal line. So this is the MACD line and this is the signal line. And you see this histogram, it is calculated based on the difference between these two. Okay, fine. Now, see, the name is moving average convergence and divergence. So what is convergence and what is divergence? Let's get to know. Okay, so here, this is the MACD. So what is convergence? Convergence is when these two lines, they try to come together, we call it as convergence. And when these two lines, they tend to move away, we call it as divergence. Okay, so let me recap MACD again. So basically, MACD has two lines, which is the MACD line and the signal line. So the white line and the red line. And we have a zero line, and we have the histogram, which is the difference between the MACD line and the signal line. So this is basically how you can see and visually interpret MACD on Alice or any trading platform. Okay, now we'll go to the next one. All right, now I showed you what was MACD and what are all the different, like two lines, you have a single line in the middle, and then you have a histograms. So there are multiple ways and strategies of trading using MACD line. First of all, I showed you the two lines, which is the red and white in this case. So every time there is a crossover between these two lines, there is an entry. If the line crosses upward, it's a buy call, and if the line crosses the signal line downwards, it's a sell call. Let's see this. Okay, now here, okay, fine. Here, the signal line is crossed by the MACD line upwards. So here there is an entry for buy. If you're entering here, the price is around 185. You see how far it goes. From 185, it has gone up to 195. That's a whopping 10 rupees different. I'm talking about intraday. If you're closing it on the same day, this trade was done at 12:05, and if you're closing at say 3 o'clock, still you get a huge profit here also. 188. Okay, so this is one entry for a buy call. All right, now here we're getting one more entry, which is a sell. Here we are getting a sell call, and here again we are getting a sell call. And this is a buy call, and this is a buy call. So you see here, this call was successful. From here to here, the price went, and this call, the success was very narrow. If you're going to enter here, the price is not so. It's not a big difference. I'll just show you now. You see this? We are entering here. This is the price, and here in this case, we are entering here. We are getting such a huge margin, and here again, if you are entering here, this is the maximum profit, and here, this is what you get. See, all these entries are based on the crossovers of the two lines. So this is strategy number one. So I have shown you two entries and two buy calls and two sell calls. This is how it works. Okay. Let me explain it on screen itself. There is one more way, which is see, in this case, we had two lines. We are considering two lines and the crossover only. And here, the second strategy is whenever the MACD line, that is the white line, is crossing the zero line. If the white line is crossing the zero line upwards, we go for a buy. And if it's going for downwards, we call it as a sell. Let's see this now. Here, what we have is that this is the white line. The strategy is whenever this white line crosses the zero line. For example, here there is a crossover, here there is a crossover, here there is a crossover, or here also this is a choppy crossover, but still there is a crossover here, and we have a crossover here. There are 5 different calls. Let's see what happens actually. See, here there is a small profit range because it's a sell, and here we get a huge profit, and here we get a very no, this is a failure because it went up, so this is a stop loss. This one is not going to work. That's the reason we have a stop loss. Okay, now here we have a buy call, so this definitely works and we are getting a profit. And here we have a sell call. From here the price goes down. We don't know what's going to happen tomorrow, but still the price goes down. So this is second strategy. wherein we are going to use only the MACD line, which is the white line, and whenever it crosses the 0, we get a call. If it goes up, it's a buy call, and if it goes down, it's a sell call. So this is the second strategy of using the MACD. Now, let's go on to the next one. All right, now there is one more way, which is I showed you this bar chart, it's the histogram. So the histogram itself can be used for trading. So how it can be done? Because you saw greens and you saw reds and you saw it down and you saw it up. So one way of using the histogram is whenever the histogram crosses from below 0 to above 0, it's a buy signal. And again, only the histogram when it crosses from up to down, that is on the 0 line, when it crosses from up to down, we call it as a sell signal. So this is one more strategy. Let's see this. Here in this case, for example, this is the histogram. What I'm saying here is the strategy is when the histogram crosses from 0 to up, and then here, and then here, and then here. So I've got 4 signals. Let's see what happens. 1, here it's a buy signal. Yes, definitely it works. 2, we got a sell signal. Yes, it's not a huge profit, but still it works. And 3, we got a buy signal. Yes, it works. Here we got a sell signal. Yes, it works. Fine. So I think you got an idea of how to use the histogram to get buy and sell signals. So this is one more way, the third way of how you can trade using the histogram. And there are also some more ways which I'm not going to explain. For example, when this changes from red to green and it goes down, we are not going to get into that. So I've given you three different strategies. Number 1, which is going to be whenever these two lines, the MACD line and the signal line, they cross. If it is upward, it's a buy signal, and if it's going down, it's a sell signal. This is strategy number 1. Strategy number 2, we are going to use only the MACD line and the 0 line. Whenever the MACD line crosses 0 from upward, it's a sell signal, and when it goes from down to up, it's a buy signal. Again, okay. So this is second strategy using MACD. Then the third strategy is using only the histogram. Whenever there is a change from 0 to up on the histogram, only when there's a change from 0 up to down or 0 to up, up to down or down to up on the histogram, we get trade signals. So these are 3 different strategies. Caution, do not mix these strategies. MACD has, even there I can give you more strategies, but if you're going for one strategy, stick to it. Do not change. Do not mix. See, you're seeing sometimes you start with like the first strategy of 2 lines crossing over, then suddenly you change it. No, it does not work. Before the trade, you select which strategy you're going to use and stick to that. Do not mix stuff. Okay. Now let me go to the presentation again. Fine. So these are the 3 different strategies for MACD I showed you. That's it. I think today we have given you a summary of candlesticks, the basics, how to understand a candlestick and how to read a candlestick. Then also we have seen what are moving averages, the different types of moving averages, and then how there are strategies for intraday and also for long-term investment using simple moving average and exponential moving average. And also we had MACD, an introduction of what is MACD, the signal line, the MACD line, and then the histogram and the different strategies of how to use them. I think we'll go for the questions now. Any questions on these? If you have any questions, please type it on the question and answer. Do you have any questions on the points we discussed? Please go ahead and ask. Can we use only candlesticks for trading? Yes, you can use candlesticks for trading. These are only the candlesticks. And how do you know? See, only candlesticks you cannot trade. you need to have some sort of indicator or some sort of oscillator or some sort of trend analysis, because you should know when to enter the trade and when to exit the trade. Even here we are using the candlesticks only. For example, here we are going to buy at the high price of this candle. Here we are going to sell at the low price of this candle. So the candlesticks are very important. Open, high, low, close. We are not going to trade just with the candlesticks, but we are going to trade basically with the candlesticks and combining with the different strategies like having an indicator or having an oscillator and having a trend or having a volume or having a momentum, and all these things. Okay, fine. The question I have is, I want to know which moving average to be used in intraday. See, as I told you, simple moving average is slow. It's not going to follow the price very fast. It's going to be slow. So simple moving average is slow. So you should try yourself. Check out DEMA, which is double exponential moving average, and check out TEMA, which is triple exponential moving average. These are all faster. So they almost travel with the price changes. So the answer is check out DEMA, TEMA, and exponential moving average. You can also check it with the close price or the OHLC price. There are a number of combinations which you can use it. Okay. Now, what stop loss should we keep while entering with the help of MACD? Shall it be a high or low of two previous candle? Again, see, these are all based on the risk level for you. Okay. If you have if your capital is say like 20,000, you can keep a risk of 1,000 rupees. So according to your trading and your risk level, you should keep the stop loss. You should not, worst case, if stop loss hits, that's it, done. It cannot be fixed. See, the prices cannot be fixed. I'm just showing you now today only on moving averages and MACD. In the coming weeks, we'll be showing you different combinations of different oscillators and different, like for example, RSI is there. For example, ADX is there. We have stochastic. So there are so many combinations which are going to help you, because there are some false signals coming out of moving average. Okay, so to keep the stop loss, you should know about the support and resistance basically. How to, like the question is, entry is okay, but how to fix target? See, this is again I'm saying, the target here is, it's not predictable because MACD is only historical. It is not giving any prediction. So in today's section, we are talking about MACD. Here there is no prediction. So what happens is, keep, like for example, if you're trading, say State Bank, SBIN, the share price is 200. So you can keep the profit like maximum like 3 rupees. You keep the profit like the target as 3 rupees, and you keep adjusting the stop loss towards the target. You get the point? Keep a higher target and change your stop loss as the price moves towards the target. Do not miss the opportunity. Okay, now let me go to the next signal. Next question. Which time frame is good for intraday? See, 1 minute, less risk, and you get hundreds of signals. 5 minutes, you get lesser signals, and still there is a possibility of false signals. You can either try with 10 minutes or even 15 minutes or 30 minutes. I think you can try, if you are not going to take any risk, you should go for 10 minutes. This is not fixed. Please check yourself by backtesting. Go to this Alice Blue app, open it, check your strategy by yourself. Go to this, you select the time frame, and then you can check your own strategy. Like you are asking me which exactly is good. See, the problem is it's not fixed. Some days the market is highly volatile, and some days the market is choppy, and sometimes it's not fixed. So what we have to do is, you have to, based on your risk, like 1 rupee, you get very less risk, but a lot of signals. You will get hundreds of signals. Okay, 5 rupees, still there is risk. 10 rupees, still there is risk. 15 rupees, still there. There is a risk on all these things because the higher you go, if you're going for 15 rupees, 15 minutes, the moving range is high. It can go for a wider range, either towards profit or towards loss. So the time frame is based on your risk level. Okay. Which moving average is good to use for intraday, like 20, 50, 100? See, which moving average? Are you talking about simple moving average, or are you talking about exponential moving average? See, I showed you two strategies. One is single moving average line, and then there is a crossover. This is one strategy. For this you can use 50 is good enough. And if you're going to use two different moving averages and go for a crossover, you can check out. Like I showed you 50 and 200. See, again, I'm saying, see, these are all to give you an eye opener to understand the basics. Okay. Then I'll give you some orientations, like because Mr. Kamaraj's experience and his knowledge, whatever he has transferred and he's been sharing with me for even today's presentation, is what all I'm giving it to you. You have to do paper trading or backtesting. This is the crucial. Never jump out directly. And there's one more point. See, you have to identify if the volatility is high or if it is bad. If it is a range, it's a trend market or a range market. You can use ADX. There is an indicator called ADX. You can use ADX to identify if it is a choppy market or if it's a trending range. So we will see about ADX in the coming weeks. Any more question? Okay, like to make it simple, SMA it's a slow indicator, and EMA, which is exponential, it's going it's following the price in a faster way. Many advisors says my software giving breakout signal in particular stock and they give entry and target. Okay, see, this is out of the subject for today, but anyway, I'll just give you. See, there are a number of ways to trade. First of all, it's called as breakout. Breakout is when there is a range and it breaks out. And there is a type of trading which is called reversal, which is like once it hits the range, it comes back. This is called reversal within this, and breakout is outside this. There are a lot of strategies. See, again, I'm saying, please do not use the systems blindly. Always, you have to do your own research. You have to understand the basics. All the indicators and all the oscillators and all these trends, all these things, there is no way that it's going to work on all days and all times. There are times when the indicators or the tools that are used are working perfect. You yourself check. Take a number of days and you check by yourself. You will see on some days it will not work. On some days it works very good. So you just have to check how it goes, because there are so many factors with the current volatile situations and the external factors. So I think that's it. So thank you for joining us. And if you have any more questions, you feel free to, you can post to us on the group, or you can contact me directly. No issues. I'll do my best to help and guide you with the best practices. So thank you all for joining us today. I should really thank you, because there are so many guys who have joined today. Let's please check out these on the previous days, the strategies that we discussed. Please check out on the previous days by yourself. Check paper trading and do the previous backtesting. You will get your own insight. Okay. Thank you. Good evening and goodbye.